Welcome back to part 3 of Real Estate Economics weekly webinar series. This week we're covering the Ventura County MSA. In this section we'll be covering our housing market model for this particular area. As we've talked about in previous sections, the supply of housing, shown here in blue, tends to grow very slowly. You can see the whole period from 2006 through the end of the forecast period in 2015. This market area goes from 270,000 units only to 280,000 units. Supply is very constrained and grows very slowly. Compare that to the demand for housing, which is showing in the bumpy oscillating green line. The demand for housing ties back to employment, which grows very quickly during periods of economic expansion, and as we can see, contracts very quickly during recessions and economic disruptions, credit crisis, that sort of thing. So as the demand for housing grows very quickly, it can quickly outstrip the slow-growing supply of housing, and that puts upward pressure on prices. We can see that sort of period all the way from 1999 to about 2008. Then we entered the current disruption, lost a lot of jobs, and really now demand for housing totals numbers that are far fewer than supply, which leads to declines in value. We can see that manifest here in our housing valuation chart. The blue line is the historical or forecast median home price. Green is the supportable. Now the supportable is created by household incomes and current interest rates. What size of loan, what sort of house price can you afford in this particular market given household incomes and current interest rates? In most periods of history, these two are well tied. People couldn't qualify for loans that were far beyond their financial capabilities until subprime came along. Once subprime came along, people used liar loans to get any sort of loan and got a lot of extra money. The only way that could really outlet itself was through higher house prices. So we saw house prices run up from 400 to 600 in just a couple of years and come back down just as quickly. Look to the supportable median home price, the green line again, from about 2010, and you can see the trend is sideways to slightly lower. Household incomes are growing moderately in this particular area, but we're expecting a gradual increase in rates, which is going to keep the equilibrium home price relatively steady here and let the historical median home price catch back up and eventually cross or match in about 2013. The difference between those two lines, between the green line and the blue line, is telling us that there's tremendous undervaluation on the ground here, that current incomes at current rates can support much higher house prices. The only reason they don't, of course, is confidence. People don't feel stable in their jobs, they don't feel stable in their industries, bad news, you read the paper every day, and so this period of undervaluation continues, but over time it will be recognized, and with a little bit of improvement in the labor conditions, people will gradually buy homes again, and causing that blue line to move up over time. Here's our residential opportunity risk index. Housing demand on the far left we've talked about, ties very closely to employment. You can see the demand numbers that are down in the last 4 or 5 years as we've lost jobs, as this recession has taken hold, and even as it ended, when it's failed to produce jobs in any meaningful number. That leaves weak demand, lower demand for housing than supply levels. Supply levels, even though they've been growing slowly, are greater than current demand, and that leads to the overbuilt condition you can see in red. The overbuilt condition now we've got is fairly significant, about 6% of the housing stock, again really caused by the loss of employment in this market, producing a situation where the housing stock is simply too large for the employment base as it sits today. Towards the middle, the median home price, that's just a historical number that we record over time and we forecast out. You can see there's been quite a bit of damage to that since the end of subprime. And the annual price change in the middle of the chart. Now this is showing some gradual price uptrend over the next few years, which really isn't caused by some dramatic improvement in the economy, but it's going to be caused by a reduction in the undervaluation. So think, we've got the equilibrium home price here almost in the center of the chart. What's that a function of? That's a function of median household incomes and current interest rates. Stated another way, what sort of home value can a local income in this area support at current interest rates? And what that is telling us is today, as we sit today, this particular market can afford more expensive homes. The only reason it doesn't is for confidence, job insecurity, economic reasons. But over time, with a little bit of improvement in the economy, that undervaluation will be recognized. People will again move to buy homes, and that undervaluation will gradually disappear. Now, we're a little concerned about the household income at this point in time because we think we're obviously going to get the expiration of Bush tax cuts, taxes on employer-provided health care benefits, so take-home pay might not be what it's been in the past. We'll have to watch that very closely in 2011 to see how that affects the ability of buyers in all markets nationally to afford homes with potentially significantly lower take-home pay. We index all these factors on the far right with a 2-year lead time, so that before anything happens on the ground, before you get reports from your sales offices that things are perking up, before your competitors start reporting higher home sales, we've evaluated the economic conditions and indexed those and reported conditions on the ground in 2 years. Let's go to 2008 in this particular case, where the market changes from weak to stable. So here we are in the end of 2010. We're starting to see the 2008 numbers express themselves on the ground, manifest themselves on the ground, and what are we getting? We presented earlier that the resale market was picking up in terms of volume, in terms of conventional resale volume. It's picked up in terms of outright base price. It's picked up in terms of value ratio. So we're starting to see the early inklings of those economic factors that were first seen back in 2008. Let's come to 2009. We report a change from stable to stronger market conditions on the ground. So gradually, a little bit of improved psychology, improved job market performance, and people recognize this undervaluation, begin to act on it, and more homes are sold. Prices can continue to improve in this particular market until this huge undervaluation corrects itself over time, and the undervaluation and the condition of overbuilt and underbuilt once again sync up in about 2014. But until then, this market presents a tremendous value for people who have means, who feel stable in their jobs, to acquire a home at really historic levels of undervaluation. You can already see this to some extent in the rental market, where we've got investors out, culling the market for good homes with good schools, homes in good commuting distance to employment, this sort of thing. They're buying those homes, putting them out to the rental market, only to presumably resell those in 3 or 4 years when the economics are improved. We like to evaluate the housing market from a perspective other than sales and prices and how many projects are out there, how big the premiums are. So let's take a look this afternoon at lumber prices. This is framing lumber, 2x4s essentially on the Chicago Mercantile Exchange. The price index on the right is price per 1,000 board feet. Well, what we'd like to point out here is that this market had the peak numbers, about $340 per 1,000 board feet back in late April, when the market was essentially, the commodities market was essentially pricing in a much more robust economic rebound than we've in fact had. And as that realization figured into the psyche of traders, this market's come off considerably and now has been essentially range bound between about 210 and 220 since the end of June till August. Lumber prices would typically predict improvement in the housing market, particularly since it's framing lumber. You can see on the bottom open interest, that's the number of active contracts, has declined. No one's really interested in taking a position in lumber for any sort of near-term delivery unless they plan on using that in houses or if they're some sort of supplier. What this is really telling us is we've got a couple of months of quiet activity, probably not prone to too much downside shock. It looks like the bad news is in the market here. We'll watch this very carefully towards the end of the year and into 2011, since this will be a good predictor of improved psychology and amongst construction-related industries. Here's the S&P 500 Home Building Index. This is an index that includes all the publicly traded home builders, many of the suppliers such as Louisiana Pacific, the materials companies, American Gypsum. Its one shortcoming is that it includes companies, retailers like Home Depot and Lowe's. Many times the retailers, or at least recently, have been performing better than the home builders. So this particular chart is synced up the same time period as the lumber chart. So you can see expectations improved. They come down quite steeply and now have flattened out over about the past 2 months, 10 weeks. This index is trading below all three moving averages, which you can see in the red line, the yellow line, the blue line, suggesting that we don't have an uptrend in place here. Frankly, we think almost all the bad news possible is in the home builder stocks. If you take out the retail side of this and just go through the home builders, they have not been prone to much downside, with the bad news about new home sales and the bad news affecting the home building market recently, which to us might be the early signs of a trough in home building. What's our summary and conclusions about this market? Ventura has a reliance on LA City and LA County employment. For those of you who don't know the area, LA City has a tremendous budget deficit and quite a few fiscal problems that they really can't let roll from year to year, since it's a small municipality who can't print their own money, so they're forced to make a lot of budget cuts and do a lot of accounting gimmicks, which seem to be very popular. But that affects Ventura. Ventura really grew quickly when LA County was strong, and so now the reverse is taking place. One of the attributes of this market, we've tended to consider in a lot of areas non-farm payrolls. This area also has a substantial farm sector. We've seen across California quite a bit of degradation in farm employment due to imported farm products, but Ventura County has high-value farm products, readily degradable farm products, strawberries and different things that don't like to be transported great distances, and that's been a tremendous benefit to the area. Satellite and branch operations have consolidated back. This goes back to the employment in LA County. Companies tended to branch up to Ventura and into outlying areas, but now they've been forced to retreat in efforts to reduce their overhead. Foreclosed homes in this market are going to be better at meeting rental demand than buyer demand. There's a lot of homes that can immediately go to the rental market with a positive cash flow, but we've seen very little evidence that distressed inventory goes out to potential owner occupants. Many people don't want to move into an older neighborhood where they don't know if their neighbors are going to lose their homes in the next few weeks or months and drag down the value of their newly purchased home. People will prefer new homes if the premium to the resale market's not overstated. We like this area for retirement. The only caveat to that is many retirement buyers are going to look out of state for lower living costs and better budgets. This is a tremendously beautiful area with a lot of physical and natural attributes that support not only retirement, but for technologically employed buyers who aren't tied to an office, who can work wherever they want to, who don't have a static work location. They're going to be interested in a market like this. Here's an overview of what we do at Real Estate Economics. We do residential market consulting, site-specific feasibility. Land value optimization is one of our favorites. Our online research services, housing transaction report, new housing profiles, and statistics. This is our team. Many of you know Mark. I'm John. If you've seen anything or heard anything today you're interested in, please give me a call. Shown below, Judy Dewell's our head of subscription sales, and Sandy's our customer support. Please make sure you use all of our resources and that you're getting the most out of your subscription. Thank you for joining us. Join us again next week.